This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stop being patient? Stocks tumble as the Federal Reserve begins its two-day policy meeting as investors wonder not only when the Fed may raise rates, but by how much and for how long.
Snow stall, a dramatic drop in housing starts. Many blame the winter weather, but is there something bigger at play?
Currency jolt Oracle becomes the latest company to see its profits hit by a stronger dollar. All that and more tonight on Nightly Business Report for St. Patrick's Day, Tuesday, March 17th.
Good evening, everyone, and welcome. It was a day unlike most other days right before a Federal Reserve press conference. Usually it's quiet and traders hesitate to take big positions ahead of the central bank chair's question and answer session. But not today. As the Fed's two-day meeting got underway, the Dow Jones Industrial Average saw a triple-digit decline, its seventh triple-digit move in the past 8 sessions. By the close, the blue chip index fell 128 points to 17,849. The Nasdaq rose about 8 points, and the S&P 500 was off nearly 7. The Federal Reserve so far has been patient in raising interest rates, but that could change tomorrow, as many speculate the central bank is laying the groundwork for its first hike in almost a decade. Steve Leisman surveyed some of Wall Street's top economists to see what they're expecting.
The word is just 8 letters. But there's billions of dollars around the globe riding on it. The Federal Reserve looks set to remove the word patience from its statement, a word it has used to signal that there would be no rate hike for at least 2 meetings. But 69% of respondents to the Fed survey say the U.S. Central Bank will lose patience, the word that is, and pave the way for possible rate hikes in the months ahead. When? Survey respondents dialed ahead their expectation for the Fed's first rate hike in 9 years to August of this year from September. But they see very gentle rate hikes. The Fed funds rate is forecast to be below 2% at the end of 2016 and ratchet up to only 3% at the end of 2017, both low by historical standards. But not everyone thinks the Fed will be quite so easy.
I think the Fed has been slow to act and is a little behind the curve, and as a result, they may end up moving a little faster than what the markets have priced in.
In fact, 54% of respondents to the CNBC survey think the Fed is too easy, that is, behind the curve, the first time that number has been above 50. But complicating the Fed's decision is the likelihood of declining inflation, caused by lower oil prices and a strong dollar, which lowers import prices. That could give the Fed pause from hiking rates too soon, because inflation will remain below its 2% target.
I don't think the Fed's really so much on the verge of raising rates right now. I think they want to. I don't think the data are going to accommodate it.
But the Fed is only clearing the runway for a rate takeoff by removing patience. How quickly rates take flight and how high they soar, well, that debate will begin nanoseconds after the Fed releases its statement. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to our 2 economic experts who have different points of view on how fast and how far they think rates will go. Bob Brusco, whom you just saw in Steve's report, he's a familiar face, chief economist with Fact and Opinion Economics. We asked him to bring all his facts, all his opinions, and Joel Naroff is president and chief economist at Naroff Economic Advisors. You two guys don't agree here, not one bit, as Dr. Seuss might have said. Joel, let me start with you. You see rates moving a quarter point at a time all the way through the end of next year, so we end up at 3.25% by Christmas of next year. You heard what Steve said. Do you really believe that the Fed would risk slowing the economy in the face of an election campaign and risk deflation by raising rates that far, that fast?
Well, first of all, I don't think it's that far, and I don't think it's that fast. It's a quarter a point a meeting. You would get 8 meetings, so you wind up with 2 percentage points a year. If you think about it, people are panicking that the Fed might be all the way at 1% by the end of this year. The interest rates at 1% do not slow the economy down. It doesn't affect housing. It doesn't affect business investment. It's not affecting the interest-sensitive sectors. So I don't think the Fed has to worry about it, and they have to get going as far as getting rates back to normal.
But, Bob, we heard a little bit of what you were saying in Steve's piece just a moment ago. You're not sure there really is solid economic growth yet.
No, I don't think there is. There's strong job growth by the numbers, but we know the job growth hasn't been strong enough to push up average hourly earnings. We know the productivity data have been poor, so the jobs we've created have been low productivity jobs. not very high-paying jobs. We're not getting, I don't see where we get the income growth to drive prices to create the inflation people are worried about. If you look at inflation for the last 10 years, every year from 10 years, 9 years, 8 years, et cetera, you have inflation below 2% and falling even more recently. I think the Fed is way overreacting, concerned that all this liquidity is going to create some problem, when in fact the Fed is regulating the asset side of banks' balance sheets with its capital asset ratios. There's no danger whatsoever that banks are going to step up their lending and create an inflation bubble.
Joel, you must disagree.
I absolutely do. First of all, we've already begun to see some of the changes as far as wages go. We've got Walmart and some other companies announcing that they're raising wages. That's going to have to be followed. And I think that we're also misunderstanding the relationship between productivity and wages. We have a simple relationship. Wages equals price times marginal productivity. But the reality in the real world is that over the last almost decade now, workers have found that if they work harder, they don't get higher wages. So they don't work harder. That's part of the reason productivity has been so weak. It's not because we're hiring people into lower pays, lower productivity positions. You look at where the jobs are there across the board. It's the fact that there's no incentive to work harder and create greater productivity because the wage gains don't follow. And that's what's being missed by this analysis.
Yeah, Bob, talk to me about the dollar and the strength of the dollar. Some say that that is a de facto tightening and it kind of frees the Fed up to wait longer if they want to wait. And at the same time, it's not just the strength of the dollar, but the velocity of the move in the dollar that is somewhat worrisome to some on the street.
The dollar's a problem. I mean, you can look at this domestic dynamic that Joel's talking about. You can try to argue, is the dog chasing the tail or is the tail chasing the dog? The problem is that there's all this international competition because of the strong dollar. And what's happening is labor in the United States is getting increasingly expensive, while labor abroad is getting increasingly low. In addition, we have this low oil price thing in the mix that's decimating the U.S. energy sector, which is a relatively high-paid sector. And so you put all these things together, you have the U.S. and this economy, this global economy that is not growing fast, where Europe is challenged, China is challenged, Japan is talking about going back to 0% inflation. Europe is hoping like crazy that if they pray at the altar of quantitative easing, something good will happen, and it just doesn't look like those pieces are coming together. So I don't think there's global demand. I don't think there's domestic demand. I don't think there's domestic income. And again, the Fed is basically regulating banks by looking at their asset side and controlling capital asset ratios. There's not going to be a lending bubble. We're not going to see this price inflation. You can raise minimum wage at Walmart, but you're not going to really create any kind of wage inflation in the U.S. It won't happen, and the strong dollar is one of the reasons why.
Joel, let's turn to housing. We saw some weak housing start numbers this morning, and the housing market has not been really terribly robust for a variety of reasons. What would rising interest rates do to housing? And I believe you think it actually might, rather perversely, give it a boost.
I absolutely do. First of all, I don't think this report was weak as far as the housing market's concerned. What we've learned a long time ago is that builders don't speculate anymore, and permits went up. If permits went up, they expect to use them, look for housing starts to surge. But the other aspect about the housing market is that we have half a generation now that has looked at either mortgage rates going down or being flat, and they're low. They don't even think about the idea of mortgage rates rising, so they're taking their own sweet time as far as buying is concerned. When mortgage rates start buying, buyers are going to have to say to themselves, before things get away, I better make that decision.
I take your point on housing permits being a better measure than housing starts. Joel, thank you very much. Interesting conversation, gentlemen. Bob Brusca, Joel Naroff. Next time we'll do it in a cage match kind of setting. We appreciate it.
Oh, good.
All righty. A drop in housing starts, as I mentioned last month. According to the Commerce Department, groundbreakings on new homes fell by 17% in February to a seasonally adjusted annual rate of 897,000. That was well below expectations, the lowest level in more than a year, with both single and multifamily housing losing much of the weakness, being blamed on the weather, of course. But there could be something bigger at play, and Diana Olick is onto it.
A sharp drop in construction of new homes. It's adding insult to injury in a spring market already suffering from a lack of properties for sale. Some blame bad weather, but it's likely more than that.
It's consumers still feeling some reluctance over coming back into the market. And certainly we were missing the first-time buyer. So that's been a big loss all along.
Still, some are blaming colder than average temperatures and heavy snow for the huge drop in total starts.
February housing starts were down 17%, but permits were up 3%. That tells me there was a clear weather effect in the data, as permits would not be distorted, as were starts.
But looking just at construction of single-family homes, which are most desperately needed, the picture is less optimistic. Single-family starts fell dramatically, and building permits, an indicator of future construction, were down 7%. Builders whose confidence in their market has been falling for 3 straight months are being very careful, watching meager foot traffic and adjusting construction of speculative homes or those without contract buyers accordingly.
The builders that are still standing are those that made it through that terrific downfall, that huge collapse, the worst in their lives. And so they're, in general, by definition of making it through there, a little more conservative.
Pennsylvania-based builder Hovnanian is dropping the number of so-called spec homes it's building by 8%. CEO Ara Hovnanian explained on a recent earnings call.
We still believe it's prudent to maintain a few started unsold homes in many of our communities to satisfy demand from buyers who are looking for a quicker closing date. However, we'll be more selective on where and how many we are building.
Builders say they're now seeing more buyers begging for a deal, but they claim it's just not possible, not with the cost of everything going up. I asked one builder why he didn't just build cheaper homes. He answered, "Where would I find cheap land?" For Nightly Business Report, I'm Diana Olick in Washington.
And now to the oil market's volatile session and Brent, which closed up for the first time in 4 days, while West Texas Intermediate fell again on supply concerns. WTI finished the session down 42 cents to 43.46. That's another 6-year low. After the market settled, the American Petroleum Institute reported another surge in inventories.
On Capitol Hill, House Republicans unveiled their 10-year budget plan. Chairman Tom Price says the proposal will not only cut spending, but help create a surplus by 2026.
Our balanced budget for a stronger America saves $5.5 trillion, gets to balance within 10 years without raising taxes. We responsibly lay out a plan for a healthy economy, an opportunity economy, one that opens the doors for people, not subjects them to the dictates of Washington, D.C.
The plan calls for a full repeal of the Affordable Care Act, an overhaul of the tax system, and partly privatizing Medicare. The GOP budget also increases spending for the military.
The head of the Securities and Exchange Commission says her agency will develop stricter rules for brokers. At a conference today, Mary Jo White called for new regulations that would require brokers to put their clients' interests ahead of their own, a so-called fiduciary standard. It's a topic the president talked about last month, and it's an issue we've discussed here on Nightly Business Report. The SEC has been studying the subject for years, but so far has not taken any action.
Still ahead, can Apple shake up the television industry? What the technology company reportedly plans to do as soon as this fall.
Foreign exchange swings cost U.S. companies nearly $19 billion in revenue in the fourth quarter. That's according to a new report by currency risk management consulting firm Fire Apps. The average negative currency impact was more than double what it was for the prior 2 years. And the report goes on to say that the negative impact will likely worsen in the first quarter of this year.
And now to Oracle, which said today its profits were hurt, at least at the margins, by the rising dollar. The software company reported earnings per share of 68 cents. That was in line with Wall Street estimates. Revenue, though, missed. Oracle earned $9.3 billion in its fiscal third quarter. That was slightly below expectations. That's the revenue number. Nonetheless, investors did like what they saw. As you see there, the stock moved higher initially in after-hours trading. The company also increased its quarterly dividend by 25%. Dominic Chu has been looking through the release. What's the key takeaway here? Is it currency or something else?
Well, currency is always going to be a big part of the story for any of these large multinational companies, especially technology, software-oriented ones that do a lot of their business outside. The key takeaway for the currency side is that this will be a persisting issue and that you'll expect it going forward. What's more interesting about the story and why investors may be more bullish on Oracle is not what they necessarily said about the currency, but what they said about cloud computing. And cloud computing is just a fancy way of saying small, medium, and business-sized customers can actually put all of their technology infrastructure in the hands of an IBM, an Oracle, or a Microsoft, and then pay by the use. That's the key. And Oracle says it's growing that business by about 30% over the same period last year. Now, mind you, this is a small fractional part of their business, only about 4% right now for some of those lines.
Growth rate.
Cloud is, but it's a huge deal because in the statement in earnings, the founder of the company, Larry Ellison, the billionaire founder of the company and chief technology officer, said specifically that the company is on pace to earn about $1 billion in cloud-based computing revenues for this year, and he called out Salesforce.com, one of their main competitors, by name, in saying that this is a race between us and them, and we think that we're going to win. In essence, Oracle is going to beat out Salesforce.com. So if you want to know where the energy and the focus is, it's in this cloud computing, just like it is for IBM, Microsoft, and all these other big players.
All right, Dom, thank you very much. Dominic Chu.
Well, Apple is reportedly planning to launch an online television service that could be another step in further shaking up an industry already in flux. As first reported by the Wall Street Journal, Apple is in talks with some major networks to offer consumers a slimmed-down bundle as soon as this fall. Shares of Apple rose almost 2% today to $127 a share. And as Josh Lipton reports, Apple Television's ambitions could be a win for the company's hardware devices.
Now, Apple TV has become the category leader.
Apple could be about to invade your living room. The company is reportedly in talks with programmers to offer an online TV service, which would include about 25 channels anchored by broadcasters such as ABC, CBS, and Fox. The price of the service could be about $40 per month. Apple's executives know that TV viewing behavior has changed dramatically, and consumers want to watch what they want, when they want, and where they want. Apple is in a unique position to meet that demand with a range of devices, including Apple TV, its set-top box, as well as iPhones and iPads. An online TV service could help Apple sell more of those devices.
Anything that creates a larger ecosystem is ultimately about where they generate profits, which is selling more phones, potentially also more tablets. Tablets, remember, has been one of those disappointing products for them because growth is now negative. So if this service actually gets you to buy more tablets or more iPads, that's obviously a benefit.
There are challenges for Apple as it considers launching this web TV service. For example, the service reportedly doesn't involve NBC Universal because of a falling out between Apple and NBC Universal's parent company, Comcast. And Apple has plenty of competition in this space. Dish Network, for instance, offers a web-based service called Sling TV for $20 a month. And Sony also is launching an internet-only subscription plan. Still, despite these hurdles, analysts covering Apple say investors should cheer this development.
It's great news that Apple can find these new revenue opportunities above and beyond the strong profitability of their phones.
A streaming service may be just the beginning. Apple develops software, services, and hardware, and that's why Wall Street still thinks it's possible that the company could ultimately make and sell its very own television. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
As mentioned in Josh's report, Comcast is the parent company of NBC Universal and CNBC, which produces this program.
Well, you'll have to decide for yourself whether Apple TV or any of its correlates is a good deal. The most recent data show the average American household receives nearly 190 channels on its system and pays about $65 a month for it. The Apple service, as Josh reported, with 25 channels is said to cost about $40 a month. But will the mini or skinny bundles offer what you're looking for? Well, one option is Dish Network's Sling TV. It's already streaming 17 networks, including ESPN and CNN, for $20 a month, but it does not include the broadcast networks. Sony plans to begin testing its version called PlayStation Vue this spring with up to 75 channels, but Sony's been vague on pricing so far. Whatever the content cost, don't forget that you have to add the price of your internet service, your broadband, because you won't be able to watch any of these services without it.
Adobe's outlook clouds its better-than-expected results, and that's where we begin tonight's market focus. The Photoshop maker's profit rose, helped by an increase in subscriptions as customers pay more for the company's software monthly instead of buying it outright. But it is forecasting lower than expected second quarter sales and profits. Shares fell initially in after-hours trading. Before the close, the stock was almost 2% higher to $79.66. Shares of MGM Resorts surging on this down day as an activist made an investor presentation advocating the company convert into a real estate investment trust, or a REIT. The firm saying MGM could unlock shareholder value and it wants to nominate members for the company's board. The stock rose 10.5% to $21.74. DSW beat the street's estimates on both the top and bottom lines. The shoe retailer also saw same-store sales rise. It will hike its dividend to 20 cents a share. Now its dividend yield is right around 2%. The stock rose 4% to $38.33.
Burlington Stores, another retailer that impressed investors with strong results today. Earnings jumped nearly 50% in the January quarter on a rise in sales over the holidays. The company did tone down, though, its earnings and revenue outlook for the full year. Still, shares were 2% higher. They ended the day at $58.59. Macerich has rejected the takeover offer from Simon Property Group. We told you about that one last week. The mall operator saying the bid worth about $14 billion. Substantially undervalues the company. Macerich also adopted a shareholder rights plan that stops an investor from buying more than 10% of the company. That's to protect the company from a hostile takeover. Shares of both of those mall operators closed a little bit lower today.
Coming up, the future of franchises. Are they small businesses or are they part of a larger company? The issue is a legal one, and it's coming to a head in Seattle. Here's a look at what to watch tomorrow. The big event of the week, the Federal Reserve issues its policy statement, and Chair Janet Yellen holds a press conference. FedEx, often viewed as a barometer of the economy, reports earnings before the opening bell. And Apple joins the Dow, replacing AT&T after the close of trading.
The unemployment rate in 24 states fell in January, according to the Labor Department. North Dakota had the nation's lowest jobless rate, 2.8%, a sign that layoffs in the energy sector are yet to have a major impact there. Rates rose in just 8 states, with Mississippi, Nevada recording the highest level of joblessness, both of them at 7.1%.
Seattle is getting ready to roll out the nation's biggest minimum wage hike, but not without a fight. At the center of a legal battle is whether franchises are small independent businesses or whether they are part of a much larger network. The answer could have a big impact on how they do business. Kate Rogers has more.
Are franchisees big or small businesses? It depends on who you ask in Seattle, where a fight is underway over when franchise owners should have to comply with the city's minimum wage hikes. Under a June 2014 ordinance in Seattle, franchisees are deemed large employers along with businesses that have 500-plus workers. This means they will increase wages to $15 an hour by 2017. Small businesses with fewer than 500 workers have until 2021 to hit that level. Phases of the wage hike kick in on April 1st at $11 an hour for large employers and $10 an hour for small employers. The catch is that franchisees are considered large employers even if they have fewer than 500 workers. Some franchisees say the move creates an uneven playing field, causing them to raise prices more quickly to account for wage hikes than their small business competitors. Global industry group, the International Franchise Association, opposes that portion of the law and sued the city last year along with 5 franchise owners, claiming franchisees should be considered small businesses. Matthew Haller, IFA spokesman, says a decision is imminent and could temporarily suspend the portion of the law that impacts when franchisees raise wages, lumping them in with small businesses.
We believe the ordinance is discriminatory, it's unfair, and we're simply seeking equal treatment for the franchisees to be properly categorized as the small businesses that they are.
But some argue franchises can better absorb costs as they are part of big brand corporations and have access to their resources and networks.
The notion that they are akin to a mom and pop sandwich counter, I just don't think that that holds water.
In a statement, Seattle Mayor Ed Murray's office says that it stands by its decision to treat franchisees as large employers, saying, quote, under the ordinance, franchises are treated as large businesses because they receive the benefits of being associated with the large franchisor network of many more than 500 employees. For Nightly Business Report, I'm Kate Rogers.
And to find out more about how franchisees are fighting the minimum wage hike in Seattle, you can head to our website, nbr.com. And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we will see you tomorrow right here. We're taking attendance.